Good Tuesday afternoon to you. Welcome to the John Sanchez Show on News Talk 780 KOH. It's a pleasure to be with you and a pleasure to be with one of my two co-hosts. Mr. Edge is traveling this afternoon. I do have Mr. Millard of Highlands Mortgage. How are you, my friend? I love this new backdrop that you have.
I know, right? I
You
know.
look
So
impressive.
yeah, it does. A
You
little
look
fire.
so
I could get a
impressive.
little fire going back there,
Exactly.
John. Okay. All right.
This beautiful wooden, very exquisite
Mantle
looking
and
wooden. Yeah, exactly.
need a little
Yeah,
bourbon
I like
right here, or
I was just
something,
going to say
right?
that.
Yeah, a little fire.
Little
Yeah.
bourbon, little
Okay.
cigar,
All
and
right.
man, you'd just be fitting the part, brother. You'd be fitting the part.
Unfortunately, I'm not, right? I'm out there.
Right,
Yeah.
exactly.
Yeah.
You and me both. How are you today, my
I'm
friend?
doing good. How are you?
Good, doing excellent. Thank you. Doing excellent. All right, folks, let me tell you what we do have lined up for you this afternoon. It's going to be a very interesting show, something we have never done on this program before, a mortgage reset playbook for 2026. Now, what do we mean by that? Here's a scenario. What we're going to be going over with you is something that you probably are not hearing anywhere else, right? We're going to go out on a limb on this one. And we're going to make some very, very bold predictions for 2026 in regards to interest rates and the decline that we expect in interest rates next year. And therefore, the mortgage/real estate demand that we are predicting for next year. You see, folks, we're going to go into a historic time period next year, in my opinion, and in Dwight's opinion, Jason's opinion, Corey's opinion, etc. Why is that? Very simple. We're going to get a 0.25% interest rate cut tomorrow. But that's really going to do it, obviously, for 2025. But coming into 2026, what do we have lined up for us? We're going to have a brand new chairman of the Federal Reserve. Or a woman, but I think it's going to be a man. I don't see any women in the calling at this point. We know this person is going to be handpicked by the president himself. We know that the president loves declining interest rate environment. So do you not think that whomever it is, and I personally think it's going to be Kevin Hassett, do you not think that whomever the president finally chooses is going to be under very strict orders and guidance by the president to do whatever you can, Mr. New Chairman, to convince voting members of the Federal Open Market Committee to drop rates in 2026 and drop them many, many times? If that scenario happens, what we feel is we're going to share with you this afternoon is we think we're going to see a very strong stock market, a very, very strong demand for mortgages, and a very strong demand, obviously, if there's a demand for mortgages, a very strong demand for new homes, existing homes, let's just say home purchases. But what Dwight is outlined or is going to outline for us this afternoon is something very important. And that's why we're calling this the playbook, because it is time now, as we sit at 3:10 p.m. on December the 9th, to start preparing for 2026. If you're going to be buying, if you're going to be selling, if you're going to be refinancing, so on and so forth. Because the last thing that you want to have happen, and Dwight, I want to get your take on this. The last thing you want to have happen is this boom happens, like we anticipate that it's going to, and you're scrambling, trying to get a hold of Dwight or whomever, and it's like, I need a refinance or I need a new mortgage. And Dwight comes back to you and goes, well, I need this, and this, right? These documents. Right? Okay, you don't have them. All right, next person's going to come into play. You don't want to do that. You want to be at the top of the list. And that's what we're going to help you prepare this afternoon is what is the playbook going to look like for 2026? What do you need to do to get ready if you're going to buy, sell, get a new mortgage, refinance, so on and so forth?
Yeah, John, I think you're spot on. I mean, this is a good, timely topic. I'm having these conversations every day right now. I mean, specifically people that are having to close by the end of the year, how much investment cost do I put into a rate that I think is going to be lower over the counter next year? These are fantastic questions. Nobody knows, but we're going to give our opinions and based upon history and what we know and things that I agree with you. The perfect storm for just a banner 26, is on the walls. Right. Get ready, because if it's anything near 2020 and 2021, which was the record year 21, it was difficult to get a hold of people. Everybody, but there is so much, John. I'm out in the trenches just like you. And there is so much demand right now for people to sell their house and want to move.
Right.
There is.
Oh, I can't imagine. Right. Like Corey always says, you can only stay in a house for so long. It may fit your needs from a size standpoint, Dwight, But come on, we're Americans. We get tired of the same old thing over and over again. We want something new and exciting and fresh and a new neighborhood and brand new appliances and all the things that a new home brings you.
Like you said, I mean, life still happens. So you're finding school districts, you're finding, maybe closer to a hospital. I mean, they have real legitimate needs and plans to move. They've just been locked down, like we've talked about it.
Yes.
They've been locked down because of the interest rates and the environment on the interest rates that they got versus where we've been.
Absolutely. No, it's going to be fascinating to have this discussion with you, Dwight, and again lay out what we need to be ready for. First, we're going to start the discussion after I do the stock market recap of where we think rates are headed next year, and then we'll move into why waiting for the quote perfect rate can really cost you, the refinance preparation checklist, turning some of this hidden equity that you have now. What are some of the wealth opportunities you have, as we have kind of been discussing with you these last few weeks? We've got a few other points we want to talk about, so on and so forth. So there's going to be a lot of things. Get your pen and paper ready, or turn on the record button on your radio, your phone, your computer, wherever you're listening to us or watching us, and be ready to really get things ready for next year.
It'll be interesting to see how in sync you and I are.
Yeah. Dwight and I, we did that purposely. Dwight and I have not chatted about this, so I have a feeling we're always.
We're probably pretty close to the same.
Yeah, pretty close, no doubt about it. All right, so let's get an early jump on the stock market side of things today, and so we leave plenty of time to go over the real estate data with you. So what can I say about today? Today was a day where it was similar to yesterday, where we lacked conviction, right? Very typical in a big Fed interest rate decision week. Remember, today was day one of the 2-day meeting of the Fed. We'll get the interest rate decision at 11 a.m. tomorrow, our time. And then, of course, the press conference by Jerome Powell at 11:30. Wall Street, again, right now has it baked in that we're just about a 90% probability of a 0.25% cut tomorrow. But just like we experienced last meeting and every other meeting, it really doesn't matter. Wall Street's pretty good at predicting what's going to happen from the rate standpoint. But what we don't know is what the chairman is going to say. Remember, he spooked the market last month when he gave us the rate decision. He spooked the market a bit on that because it was like basically, don't count on a 0.25% cut in December. It's not a foregone conclusion. And everybody wigged out. And I remember I stood behind this microphone and I told all of you, don't fall for the trap. Of course he's going to say that. He's never going to come out and go, hey, guess what, guys? We promise you another rate cut in at the next meeting. They're never, ever, ever going to do that. So you have to learn to play the game with them. But I promise you one thing, it's going to be volatile tomorrow, whether it's on the upside or on the downside, based upon what the chairman tells us, and so on and so forth. Again, it's going to be interesting, Dwight, if he starts to say anything about, hey, you know what? I've only got a couple more meetings to be with you guys. Because remember, in May is when he's out and the new chairperson comes in. And, the president has said last week, it said he's going to make his decision who the next Fed chairman is going to be by the end of the year. And then I think it was around Thursday or Friday, he changed that and said, you won't know until after it was either after Christmas or the beginning of the year. I can't remember. He's changed it so many times. But the bottom line is that's got to be sitting in Powell's mind also. And maybe he'll be in a really good Christmas spirit tomorrow, Dwight, and he won't say anything to rock the market. And we skyrocket. Wouldn't that be a nice thing? And rates come down, because you've been battling, as I want you to go into that in just a moment. You've been battling, of course, rising interest rates, even though we did get a cut at the last one. So there's always that probability. So a lot of things to talk about there. Let me just hit a couple of the main things here. Now, here's how we finished up. I'm going to just jump to this real quick, Dwight. 179 loss on the Dow, down 0.38% to a close of 47,560, up 31 on the NASDAQ, and a decline of 6 on the S&P 500. Now, why was the Dow really diverging against the rest of the market? Well, it wasn't that way. Like I said, it was kind of a lackluster session until mid-morning when news broke in regards to JP Morgan. Now, JP Morgan, it's a $300 stock. It's very important in the calculation of the Dow Jones Industrial Average. And, of course, it's also a barometer, right? I think they still hold the title of the world's largest financial or largest bank in the, again, in the world. So Wall Street pays close attention. So here's what happened. JP Morgan finished the day down $14.74, a 4.68% loss to $300.47. The situation, the stock just sold off very, very, literally in the blink of an eye. And the reason it sold off is JP Morgan was speaking at a Goldman Sachs banking conference. The company, meaning the CFO, disclosed projected 2026 firm-wide expenses of approximately $105 billion for next year. Now, that figure represents roughly an 11% growth over the projected 2025 expense base of $95 billion and lands about 3.6% above Wall Street's current expectation for JP Morgan's expenses of 2026. Bottom line, they came out and said things are going to be a little bit more expensive. I think the sell-off today, Dwight, was overdone in the stock, and here's why. I won't waste everybody's time and go through the details, but the bottom line is a lot of the higher expenses are in relation to opening more branches, spending more money on AI. Bottom line is it almost was like a throwback of the playbook of Meta, Amazon, etc., where you go, you know what? Business is doing phenomenal. We're going to spend some of this capital and continue to grow the business. Well, as soon as Wall Street saw these higher expenses, like I said, they sold off the stock very quickly, or at least the algorithms did. I don't think it's going to last. I really don't. I'd be shocked if JP Morgan is down tomorrow on this news, because here's a company, again, massive capitalization, massive balance sheet. You really think, Dwight, that it's going to change anything on an earnings per share basis going from 95 billion to 105 billion in expenses? Especially in the environment you and I are going to talk about, which a low interest rate environment, always good for lending, always good for bank stocks. I mean, so what are we talking? $10 billion? Yeah, it sounds like a lot to the average person. But when you talk a company of the prowess of JP Morgan, $1 billion is like, you and I talking about $100. It doesn't really mean a lot, but the street took it, again, very, very poorly. And that's what drove the Dow Jones Industrial Average down. That was really the biggest story of the day. Everything else was just kind of a lackluster story. All right, let's turn it over to Kristen Snow, right now, Traffic Center. Hello, my dear. Welcome back to the John Sanchez Show on News Talk 780 KOH with Dwight Millard of Highlands Mortgage. Corey has the afternoon off. Once again, we finished down 179 on the Dow. NASDAQ rose 31. The S&P down 6. The Great Mortgage Reset, your 2026 playbook is what we're going to be discussing. First, let's hit the commodity side and mortgage rates, and then we'll get into the topic. Finished down 58 cents on oil today, 58.26 a barrel. Dwight, that's a good sign, man.
Yeah.
When you're down below the 60 mark,
Yeah.
that is such a huge benefit to the consumer,
Well, John, and you could even go back to, the pandemic when nobody wanted oil. You were, I think
Right.
you were at 36, 37. I mean,
remember we went negative at one point.
That's true.
Remember that?
That's true.
Price per
That was
barrel.
so strange.
Actually went negative. Never forget that one.
Yeah.
$20.60 rise in gold, closed at $4,237.30. And you were quiet, which is to be expected, Dwight, in the bond market, of course. 1 basis point increase on the 10-year 418. How'd we do on the mortgage side?
So same thing, quite just 1 basis point decline on the 30-year fixed to 6.35, John, 15-year at 5.79, and then the govies are at 5.9. I think the takeaway people need to understand is that we were at 6.13 before the Fed's last decision, right? So we've gone up basically 25 basis points, a quarter point in the rate since it, and it really hasn't come down at all, John, since
No, it
that.
hasn't.
And it's
It really
been,
hasn't.
what was that, September, right? No, it was October.
No, October.
Yeah, we missed a November
That's
meeting, right? Okay.
Yeah,
So it's been over a month and it hasn't moved. We've been in that 6.37, 39, we've been stuck here. So I don't know. It's going to take more than, I think, a Fed quarter point to start making a difference in these mortgage rates.
Yep, absolutely. All right. So let's start the discussion off, Dwight, by talking about what is Wall Street looking at. So, Dwight, I'm going to ask you what you think will be the number of rate cuts that we get next year based upon one of Trump's handpicked men coming in to run the Fed. Again, not being biased. There's just no women in the candidate pool. What's your best estimate as far as the number of rate cuts that you think is going to occur in 2026? We'll compare it to the street.
You have 9 meetings. I'm going to say at least 4.
Ooh, 4/4%. So a total
4/4%, correct.
4/4%.
I like
so a total of 1% overall for the year.
Yep.
All right, you're on the aggressive side. I'm more in the 2 to 3 camp, 2 to 3 rate cut camp, which right before the show, I wanted to see how I compared to everybody else. So let me kind of share with everyone what the street is looking at. Definitely smarter people than Dwight and I. Here we go. Goldman Sachs, they're forecasting 2/4% cuts next year. This is according to Goldman Sachs's website, bringing the Fed funds rate to between 3 and 3.25%. Recent market survey by Bloomberg said the median responded expecting 2 additional 1/4% cuts next year. So that's kind of the consensus of the street. The CME FedWatch tool that we quote all the time as far as the probability of rate cuts, it is suggesting that there will be 3 rate cuts next year. Though it depends heavily, of course, on inflation and economic data. MarketWatch is reporting that they're seeing 2 to 4, so they really branch it out, 2 to 4 cuts overall.
Well, John,
next
but
year.
we talked off air a little bit, and why I want to explain why my four is I think that Jerome Powell's been under a lot of scrutiny from the Trump administration to lower rates,
Absolutely.
right? So he's out. He's got three meetings: January, March, and May 6th and 7th. I mean, he's got nothing to lose to say, okay, you want to play that game? Let's do a quarter,
Right.
quarter, quarter. And
Right.
if you're right, everybody wins. If you're wrong, I told you so. So
Yeah.
that's three. That gives me still six more meetings to just sneak in one more. That's my rationale.
It's excellent rationale. Matter of fact, let me add just a couple of things to that, Dwight, because what many of you should realize is if you're new to investing, you probably never heard this before. These chairmen and in the past chairwomen, Janet Yellen, they're very prideful on what's the word I'm looking for, Dwight? The history they leave.
Legacy, their exit legacy.
Their legacy, yes. They do not like to leave with an economy in a mess, right? They want to leave where the history books write positive things about them. But let's be real, folks. They want to leaving the economy in very good shape. Why? Because the chump change that this man has made working for the Federal Reserve, i.e., the federal government, is cents on the dollar of what Jerome Powell, in my opinion, will capture writing books, being hired by Wall Street firms like all the other Fed chairmen and chairwomen do. They get out just like a politician. They get out and everybody wants to hire them. Well, do you really think someone's going to want to hire Jerome Powell if he screws up the economy in these next 2 to 3 months? Absolutely not. So to your point, Dwight, what does he have to lose? He knows the street wants this 0.25% cut. He knows the street wants 2 to 4 cuts next year. What does he have to lose?
John,
Right?
everybody wants it, right? Everybody wants it.
Everybody wants it. And again, I'm telling you, I hate to bring this perspective up, but it's the facts. This man will make a lot of money going to work for someone as a consultant or on their board. I mean, you look around, all the major Wall Street firms hire, ex-Fed people, whether it's a voting member or a former chairman or chairwoman, and they're not going to go out all tainted and go, oh my God, why do we want to hire you? You screwed things up in your last 2 months, in office. Why did you do that? You didn't have to do that. Logic says there's no rationale for that. So I thought you find that interesting.
Yeah. Yeah. Well, I think it's going to be a little bit of a love-hate fest. I mean, it's going to be one of those things he's not
going to give it to us. He's going to make us work for it.
He's going to, but I think, I think a quarter, you can already see the last 3 quarters he's done hasn't really done anything.
There's actually a few strategists on the street saying it could be a 0.5% tomorrow cut.
See, that to me, I'd rather see the quarter. I'd rather see the trajectory towards lowering and giving us more hope. That's the problem is people that it comes down to one word, hope. Is there hope that there's a better day ahead for interest rates and for people to get out of their houses and buy another house?
Yep. You're right. You are on point tonight, my man. You are on point tonight. It's got to be that beautiful backdrop you're sitting in front of. I'll tell you that. All right. When we come back, we're going to get we already covered our first point. Where are rates really headed? Now we're going to get into our point. Why waiting for the perfect rate can cost you. That's right. We're laying out your 2026 real estate playbook with Dwight Millard, and we will turn it over to Jack Saban. He's got news, traffic, and weather check. Welcome back to the John Sanchez Show on Newstalk 780 KOH with Dwight Millard of Highlands Mortgage. Corey has the afternoon off. Once again, a 179 decline on the Dow, up 31 on the NASDAQ. S&P lost 6. Again, the big weakness inside the Dow is related to JP Morgan, which was speaking at a Goldman Sachs banking conference, said their expenses are going to be a bit higher next year than this year, and they sold off the stock. All right, we're talking about your 2026 mortgage reset playbook. We've covered where we think rates are headed. Again, our opinion, mine is 2 to 3 cuts. Dwight is a little bit more aggressive, 4 cuts. The street consensus will say 2 to 3, so pretty much in line with what I'm thinking.
What I find interesting, John, real quick, is Fannie Mae's forecast for 26 rate is 6 to 6.3. It's kind of like we're already there. So, I mean, I don't know.
That's Fannie Mae, though.
I understand. I understand. But yeah, it's just, I don't get it. Yeah.
I know. Yeah. Well, they're always going to be on the conservative side too. But again, just common sense, like we talked about at the beginning of the show. It's just new chairman coming in, handpicked by Trump, confirmed by the Senate, of course. But they're going to have one mandate, and that's to lower rates at any cost.
Well, John, with that said, then we talked about. I think you're going to see by summer a 5.5
on the 30-year mortgage. Yep, and we're at 5.32 now. So
well, no, you're at 6.3.
I'm sorry,
6.3. So you got 70 basis points.
Yeah, that's possible. That's possible.
That's my
I
prediction.
like it.
Yeah.
I like your thinking.
I think
All right.
5.5 gets people really close because you can buy into the 4s pretty
Well,
reasonable.
here's the other thing too, Dwight, and all of you. Trump wants to get this housing market moving, right? It's been very stagnant. He wants to get it moving. Obviously, low rates are just one of the ingredients, but it requires people to have a good job, good wages, inflation to be down, all these other things he's trying to do. So, again, all signs are pointing to a very strong economy in 2026, rates being one of those components.
John, he doesn't have a choice. You got midterms.
You're absolutely right, Dwight. That's a great point to bring up.
I mean, that's why I say you could argue with midterms and Jerome Powell even, you could argue even more than 4. Just
no, you're right.
Because I mean, if I'm reading things that are people are getting disappointed and they're losing, in a fast food mentality country, they're losing patience on this thing turning around quicker.
Well, we saw it just a few weeks ago in the New York elections and some others around the country. No, you're spot on that one. All right, let's get to our second point, Dwight. Why waiting for a perfect rate can cost you? What do you mean by that?
Well, I mean, number one, delays can cost you, So, I mean, you've got to be ready, and we're going to talk about that later. But I mean, if we're predicting this, you're going to start to see some refinances. I mean, they're predicting at least a $2.2 trillion mortgage market next year. That's bigger than what you're probably going to be just under 2 trillion this year. So it's an
Mortgage
increase.
Bankers Association.
Yeah. Mortgage Bankers Association predicts, 2.2 trillion plus. So, and the refinance.
Can we stop right there?
Yeah.
That's a staggering figure. Where would that be, say, compared to this year, or maybe
So
give us some comparison?
I think you're going to be about a 1.95 trillion this year.
So double basically.
No, 1.9 to 2.2.
2.2.
Yeah, okay. But let's go back in 2021, John. We did 4.43 trillion. All in $4.43 trillion in 21 mortgage business.
And where were we on mortgages? That's when we were down in the 3% range, right?
2021.
Yeah.
But you remember December, I brought up a rate sheet. We talked about this December of 2019 before the pandemic. Trump's administration effectively brought rates down at 3.5. They were 3.5 December of 2019.
That's right. Before the pandemic.
Before we threw all that good money at it.
Great point. Yeah. That is a great point.
So he's determined how much he can do. I mean, I guess that's the wild card that we really don't know.
Yep.
But he's kicking out, he's shooting warning shots with the 40-year mortgage, the movable mortgage or whatever.
But the biggest thing is moving all his people onto the Fed.
Yep.
That's the biggest.
That's it.
Okay, real quickly, let's start moving on.
Yep.
Let's talk about this refinance bottleneck that you're talking about here. Why waiting on this perfect rate can cost you? What can happen in this bottleneck?
Well, so everybody's going to jump in. So you got to remember, for the last 2 or 3 years, most people have gotten 6, if not 7, above 6.5%, 7%. So we get into the 5.5 range. They're jumping. I mean, they're all coming in. And if you tried in 2021, you knew how tough it was. And sometimes you're strategizing, you see a rate, and then by the time it gets around to you, it's kind of moved off that. So these rates move every day, good or bad, they move every day, or the pricing to the rate moves. So it's an everyday occurrence, and waiting to get the bottom usually costs you because you can never time it perfect. It's usually dumb.
And haven't you emphasized also, Dwight, that there are quite a few, like thousands of fewer mortgage professionals in the industry now than, say, in 2019, 2020, when things were really booming?
John, I think we're down to about 30% of what we had at the peak in 2019. We've lost.
Not only we have demand, but no people to process.
And keep in mind, for the last 3 years, we haven't had processors or funders. So we would have to ramp up, train, pull these people out. It's kind of like a construction worker, right? Back, in Northern Nevada, when it hit. Remember, they left and went to the oil business. They're not going back to construction. So if they left this business in 22. They're probably not going to come back in as a processor and underwriter. So it's going to it'll be challenging especially if the rates drop faster than we expect.
Okay, so that's why waiting for the perfect rate can cost you. Let's go to our third point, Dwight, the refinance preparation checklist. Yeah. So if everybody agrees with what you're saying, which I wholeheartedly do, let's get us to the top of the list of so we can get our loan done, refinance or new or whatever it is. Talk about your preparation checklist.
Yes. So I always talk about 2 and 2. Have 2 years W-2s or 2 years tax returns, 2 pay stubs, and 2 months bank statements, right? 2 and 2. Have those handy. Keep them in a folder. keep them going, and maybe have your latest mortgage statement in there as well, right? Those are some key components that you need right there. Then kind of get an idea what your credit is, know what your debt. I mean, I would assume that most people, John, if they're going to go for a refinance, they're going to pay off their high mortgage. Oh, by the way, I might as well pull out some cash and pay off my other debt, right? So have an idea of bills and all that. That'll help us understand your debt to income ratios and things like that. So I think if you can just be ready and keep a close eye on, listen to the show, you're going to know when we're starting to.
Here's an idea. I'm just curious. I don't think I've ever asked you this. All right. We know if you have a 401k, the 401k rules state that you can borrow up to 50% of the value or $50,000, whichever is less. Okay. So you have 100 grand, you can borrow 50 grand. If you have 70 grand, you can borrow 35,000, right? Now, because you're paying yourself back, do you count that? I mean, you really have no way of knowing if someone has taken out $50,000 from their 401k to pay down debt. How does that work?
Yeah, no, typically we have, now if you use it to buy your house, then I will know, and then I do have to hit it against you. Yeah. But it's usually a pretty reasonable thing. But yeah, if somebody borrowed not to buy their house, I wouldn't know anything except, that's one of those. Go ahead.
I'm sorry. That's the point I'm getting to. If you go through your bills because you want your debt to income ratio to look the very best it can, and you go, you know what? I've got whatever 10 grand remaining on my car, but that payment's $600, and got a couple of credit cards, got a couple of this. I can take this $50,000 out of my 401k, which again, there's pros and cons as we discussed in the past. Pay off this debt, dramatically improve my debt to credit or debt to income ratio, which therefore, if you start doing this now before next year, it's going to improve your FICO score. Right. Now you win-win.
Right. And you're paying yourself back, right? You're paying yourself back. Right. No, that's a great strategy for people that have that can without.
It's not that one.
Yeah, no, that's a great,
because it doesn't show up on your credit bureau.
No.
That's why I was asking if you had to, report it.
But what it does is it gives you the ability to, like you said, it maybe improve your scores. If your scores are in the mid 600, you definitely, if you're going for a refinance, you definitely want to get to 720, 740 if you can. You're going to get the best pricing all the way around.
And folks, remember, Dwight has been so kind over the years. I know he'll still continue to do this. I'm going to put him on the spot.
Yep.
He will run your credit for you without a credit impact and tell you what you need to do to get that score up there. Like you said, low sevens if you're in the sixes or something to get that better rate.
Yeah. Well, and John, what we do is we do a soft poll, and I can do a what if on a soft poll as well too.
There you go.
Yeah.
And it's amazing, folks. I saw him do it with a family member. It's like, okay, I want you to pay this. I think it was $1,000 credit card down to $23. And I'm like, really, you're going to get that specific? And son of a gun, it was amazing. The credit score just shot right up. So it's a miracle what this man can do. All right, we'll continue our discussion. Let's wrap it up with Kristen Snow right now, Traffic Center. Back to the John Sanchez Show on Newstalk 780 KOH. Mr. Millard, your phone number, sir.
Absolutely, sir.
Friend. All right, we've been talking about the great mortgage reset that we're predicting next year and trying to get you prepared for it, right? Your 2026 playbook. All right, 2 points we want to wrap up with. Dwight, let's go to number 5. Okay, the buyer's advantage before the crowd arrives. What do you mean by that one?
Well, you want to be first in line if you can. And John, we were talking off air. If you're actually really going to buy a house next year sometime, why not get in the system right now? It doesn't cost you anything to get pre-approved. Credit report's good for now. I will tell you right now, what I do is if you don't have a property secured yet or looking at, I'll run a soft credit pull. So it doesn't affect your credit report. At some point in time, we can get a long ways down the line on the soft credit pulls. So, but go ahead and get in the system, get a loan number, and just.
Okay, so let's quickly walk through this. Mm-hmm. So they're like, okay, I know I'm going to buy a house next year. There's going to be a mad rush. I want to get this done. They call you up. You, again, 2 and 2, get all the documents. You get them pre-approved.
Right.
That's good for 120 days, right?
Well, the credit report's good for 120 days. We'd have to run new credit and an updated bank statement, pay stub. It doesn't take anything. Right.
Yeah. Right. But now they know what they can go shopping for.
Absolutely.
Come, January 1 when, especially if this crazy weather remains warm. My goodness, we may not even have a doldrum. It just may go right into spring. I don't know.
Well, I didn't even think about that until we were talking about off air, John. I mean, get in front of the refi train, right? The refinance train is going to mow you over.
So tell the audience why, though. Yeah, I mean, you're in the trenches. Why do you say that? What do they mean?
Well, because what's going to happen is we're already understaffed, right? So if we get a significant move and you get these 6.5%, 7% plus people off the fence going even into a 15-year, It's good. There's going to be a lot of applications. We're going to have to train new people, just like people saw in 2020, 2021, right? We're going to have to bring people up, and a lot of these people aren't going to want to get back in this business, John. So you're going to have to be patient. But if you're ahead of the curve, if you're being in front of it, even if you're thinking about refinancing, get an application in. Doesn't cost you anything,
right?
And you're already in the system. And all we got to do is a minor update, order the appraisal, and you can close soon.
And again, Dwight, let's just hypothetically, let's say you quoted a mortgage today at 6.32, and again, 4 months or so go by, they finally found their dream home come, March, April, they call you up, you run the credit again, you get a new credit stub. And at that point, according to our predictions, rates should be lower then, and they can get that better rate, correct?
Absolutely. Everything works in their favor, and all they're doing is getting in front of the crowd, right?
Yep.
Just get in front of the crowd.
All right, folks. So let's begin to wrap this up on this 2026 playbook for next year. Again, you're hearing it right from the horse's mouth, meaning Dwight's mouth. He's been in this business for almost 40 years now. If we are correct, again, it's just our best guesstimate at this point, but you see the street agrees with us, or we agree with the street. 2 to 4 rate cuts next year should create a massive refi / new mortgage boom. Get ready now. Do not wait. If you're thinking about buying, refinancing, get going on it now. Like Dwight said, I think that's best advice in the world, Dwight. Get pre-qualified now. Doesn't hurt anything. It's a soft pull. It's not going to hurt your credit, but at least you're in the system. Like you said, Dwight, you have a loan number, right?
Absolutely. Yeah, John. It's a perfect timing to do it. And again, if these rate cuts come early, it's going to happen sooner rather than later.
Right. Absolutely. Well, speaking of rate cuts right around the corner, we're expecting a quarter one tomorrow. Do not miss the show. We will dedicate tomorrow's show to what the chairman had to say, the FOMC interest rate decision. Dwight, I'm sure you and I will be talking tomorrow. Phone number one more time, my friend.
Yeah, 775-240-2022.
Beautiful. Great job, Dwight, as always. Thanks, everybody. We'll see you tomorrow on the John Sanchez Show. God bless.
Dwight Millard, NMLS ID number 241259, a licensed mortgage loan officer with Highlands Residential Mortgage Limited and Equal Housing Lender. NMLS ID number 134871. The information shared on this live broadcast is for general information purposes only and does not constitute financial or mortgage advice. Listeners should consult directly with a licensed mortgage professional for guidance tailored to their specific situation. All loans are subject to credit approval and program guidelines. Not all applicants will qualify. Loan terms and availability may vary by state and are subject to change without notice. Highlands Residential Mortgage Limited is licensed in multiple states. For a full list of state licenses and disclosures, please visit https://www.highlandsmortgage.com/licenses/. The views expressed during this program are their own and do not necessarily reflect those of Highlands Residential Mortgage Limited.